Hello, my name is Jennifer. Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this point, I'm going to hand it off to our distinguished moderator, Roger Royce. Roger, take it away.
Okay, thanks very much, Jennifer. And thank you, panelists, for all being here. Thank you, attendees, for being here. My name is Roger Royce. I am a partner, I'm going to spotlight myself for a second. I'm a corporate and tax partner with Haynes and Boone. We're an AmLaw 100 law firm. I am in Palo Alto, California, part of Silicon Valley. And this is the Idea to IPO event venture capital panel, year in review, and what's next. And we've got a great panel of VCs here to talk about this topic today. By the way, if you hear any background noise, believe it or not, there is a window washer who just showed up outside my window. So you might hear that in the background. Talk about timing. And I'll try hard not to look at him because that is fascinating. Anyway, this is our venture capital panel. I want to let you know how it's going to go today. First of all, we'll have 1 hour of discussion, panel discussion. And at the end of that hour, we will move to a half hour of Q&A. Now, if you've got questions, go ahead and post those in the Q&A dialog box. If you want to talk with other attendees or talk to us or whatever, use the chat box. But if you've got questions, put them in the Q&A box, and I will get to that at the end of the hour. What else? I want to let you know that at the end of this, I will be sending out by email to everybody who registered a copy of the recording of this event. So you'll be getting a recording of the event. There are several people that couldn't make it, and some people that want to see it over and over again. So we'll be doing that. Now, let's see, before we get started, I'd like to do a little poll as to who is actually in the audience. So take a look at the poll and let me know who's here. How many startup entrepreneurs, how many investors, industry technologists, service providers like me, maybe people in school, that sort of thing. Let me know who is in the audience. Wow, it's about 80% startup entrepreneurs. We have a handful of investors. Well, I got like 10% investors. That's interesting. We got quite a few people, like 20%, 15, 20% who identify as technologists. We've got people from education. And we've got a really good diverse group of attendees other than startup entrepreneurs, which is 75%. Okay, good. That'll be good to know. That's it for the polls. All right, we'll remove the spotlight. Okay, well, why don't we jump right into it? Again, venture capital panel, year in review, and what's next for 2022. So before we get right into the discussion, I guess what I'd like to do is ask our panelists to introduce themselves. So Jennifer Vancini, General Partner at Mighty Capital. Rupan Srivastava, CFA, Founder and General Partner at Frontiers Capital. Ben Narrison, Founder and General Partner, Tenacity Venture Capital. And Jim Simmons, Managing Partner at Good Speed Ventures. So welcome, panelists. I'd like to give each of you a couple of minutes just to tell us a little bit more about yourselves and, you know, maybe your big takeaway from 2021. So Rupam, why don't we start with you?
Okay, thank you, Roger. Just a little caveat, which I always give, because we are a SEC regulated investment fund and a hedge fund. Anything I say here is not really investment advice, and it's more for educational purposes. With that out of the way, I run a hedge fund. We have 3 investment classes. One is venture capital, of course, that's why I'm here. We invest in public equities, and we also invest in cryptocurrencies. This year, I think I'll keep it short, but we all saw really high valuations. Whatever was seed is taking Series A type of valuations, and what used to be seed level valuations are called pre-seed now. The names are different, but that is what is happening. Valuations are going up. Terms are becoming easier from an entrepreneur's perspective, because there is a lot of capital chasing sort of a small number of really high quality deals. That we have seen a lot of competition for the deals that we do. We do early stage disruptive technology companies. So we invest in AI, robotics, quantum computing, healthcare, blockchain, and we write pre-seed, seed, and Series A checks. We have seen a lot of competition for those deals.
Okay, thanks very much. Jennifer Vancini, tell us a little bit about yourself.
Sure. Hi, everybody. I'm really kind of surprised and happy to see how distributed the audience is. It's going to be hard to go back to in person in Silicon Valley. So I'm a general partner with Mighty Capital. We're here in the Bay Area, and we invest about 70% B2B tech, Series A. We like to see product market fit, reasonable revenue traction. About 30% is kind of opportunistic investment and some really key high growth pillars like health, AI, fintech, and blockchain. We're deploying our second fund, getting ready to raise our third fund next year, a year earlier than we assumed. And that's just the dynamic of the velocity we're seeing in this market. I personally feel out of breath after 2021. It's been so much more active than we would have guessed a year ago in terms of exits, deploying capital. We closed our fund 2 in March. So it's just been a machine. It's been crazy. Growing our team, incredible activity. I see that continuing into next year. And I think Rupam touched on kind of the big topic of the year was valuations. Valuations and round sizes was a really big topic this year. Of course, we're seeing that. I've been surprised though that we have seen fragmentation around that. So there are definitely companies that are raising at reasonable valuations, typically founders who've been through down cycles before and they know what down rounds look like. And they don't necessarily want to swing for the fence. They've got a number in mind and it's not necessarily $1 billion. So anyways, that's my very high level view to start this out as a wrap up for the year.
Okay, great. Ben.
All right, I'm Ben Narrison. I am the founder and general partner of Tenacity Venture Capital. I spun out of NEA about June 1st. VC for about 6.5 years. Before that, I was a investor. I started one of the first institutional seed funds in the world in 2007. I ran the equity practice of a large venture debt shop. Before that, I was an entrepreneur for 25 years with one IPO under my belt from a company I started on the back of an. So now all about everything before the Series A. That can be, I don't really care what it's called, pre-seed, seed, incubation, formation. I've done all of that. In fact, I started raising a fund on June 1st. I thought it would take me a year, maybe 2. It actually took me 25 days to raise the first half of the fund. And we were oversubscribed by the end of 5 months. But interestingly, a $50 million fund, we'll expand it a bit because I brought in another partner. Interestingly, my other partner has been able to bring a lot of capital to the table that I've mainly said no to because I want to keep the fund appropriately sized for my pace. And historically, even though I'd see 1,000 to 2,000 pitches a year, and now with YC at 1,000 pitches, I can quadruple that number because I'll see them twice. And there's another 2,000 companies I get to look at. Although I think I'm going to give up on YC at this point. So anyway, net, my partner kept bringing in more money and I kept saying no. And then he said, Ben, you realize we've already deployed 30% of the fund in 4 months. And I looked at it and he's absolutely right. And this speaks to something that's happening right now, which is the pace of opportunity is stunning. And the quality of entrepreneurs is off the charts. 2 years ago, I predicted when we did our little offsite to talk about what will COVID change, that we would see an explosion of entrepreneurship because of COVID. Everybody's at home, they have free time, they have nobody looking over their shoulder, smart people, some of them are out of work, some are not, but they might want to do something else. But I assumed it would be micro entrepreneurship, lots of side hustles. That's not the case at all. There's certainly plenty of that, but I'm able to fund companies and people right now that are just as good a set of founders as I've ever seen in my life. Seasoned executives with phenomenal experience, a co-founder that had a $35 billion IPO under his belt that just came out to do a new, won that one away from Sequoia and Benchmark. I'm very, very proud of that. By the way, raise it from seed people. There's no reason to raise it from VCs. It's just silly. There's so many reasons why not. Anyway, so it's a wonderful world right now. It's going at a super exciting rate. I would echo everything everybody said. Interestingly, the first speaker commented on, seed is the new Series A. I was just looking this up. On June 4th of 2014, I wrote a story for TechCrunch. Series A is the new Series B. This has been true. Seed has been the new Series A for 7 years. The thing that's different now is that in 2014, Seed was the Series A of 2004. Today, Seed is the Series A of 4 years ago because seed rounds have gotten bigger, but and Series A's grew as well. It's really crazy. And I want to make one last comment. I don't want to monopolize the time. It is a great time, but it remains a tale of two cities. You hear the stories of the successful funds that were raised or the entrepreneurs that have raised ridiculous rounds, but I run a site, pitch-ben.com, where I put a note up for everybody. Please pitch me if you want to. I'm happy to give you feedback. It took me 300 pitches on that site before I funded the first company. So I get that for 299 people, the answer wasn't, wow, it's easy to raise. Wow, I'm getting paid huge valuations. It's a tale of the top 2% right now, at best. Those folks are writing their own ticket and everybody else is slogging through. And sometimes, by the way, I was an entrepreneur that had to slog through. Slogging through is what it takes. There's a reason my firm is named Tenacity. Tenacity is the only secret to entrepreneurial success. Brilliance and a great idea are assumed or I wouldn't have funded you. The difference between your success and failure is often whether you're willing to fight through in one of the hardest jobs known to the human, with the exception of being a first responder. It's just a hard thing to wake up every morning with 100% of the people in your company responsible to you. You're the one. You screw up, a lot of people don't have jobs anymore. It's a hard, lonely life. Don't underestimate that.
Okay, thanks, Ben. Just a heads up, I'm getting a low bandwidth warning, so you're cutting out on some stuff, so you might keep an eye on that, mute your video sometimes when you speak. Hey, Jim Simmons, do you agree with all that? And tell us about yourself.
Sure. Hopefully I'm coming through okay, bandwidth wise. Yeah, Jim Simmons, Goodspeed Ventures. We do enterprise deep tech hardware, often physics and chemistry based. And it is a little different. There's not that many people doing that. And our deals will often they don't have the high sales and marketing costs that software deals have. And they tend to be more profitable sooner. It's just a very different trajectory. The year has, there's been some COVID impact on some of our sectors. We think post-COVID, it will be, very good. There's experts saying people are going to want to see in person again, and we think that's a powerful motivator. In terms of funding, agree on what everybody's saying. Will the current situation, you could call it froth or whatever, continue? I don't know. I mean, hard to see it continuing forever. Maybe, well, not forever, but it could continue. On the other hand, it may get back to more basics, more fundamental things. So we'll have to see. But, our firm, we think one of our deals, we think is the first breakthrough viable water treatment system since the 1960s. So we're kind of excited about that. We have another early stage deal that's fashion and technology, and it's counterintuitive to the current AI, views. So we're excited about it. And, sometimes there are different tales. Absolutely.
Okay. All right. Thank you. Okay. Let me kind of jump into something really topical. The president just finished speaking about the new variant of the COVID virus and some of the things that are going to be implemented. I haven't, digested everything that he said, but it kind of raises this issue as to, I know I said we're going to look back on the year behind us, but boy, how does that impact what you think is going to happen in 2022? Is it affecting your decisions? Do you see, is it going to be gloom and doom, or are there new opportunities? Does anybody want to jump in as to whether they've got any reactions to what just happened?
I can speak first if that's okay.
Sure, sure.
So I think what we have been monitoring here are sort of the number of cases which have definitely exploded. Many large countries are seeing the highest number of daily cases that they have ever seen. So that is a cause of concern. However, the number of deaths have been much lower. The reason for that is most likely twofold. One is the high levels of vaccinations since the last Delta wave, where vaccinations were just taking off. And perhaps Omicron may be a faster spreading but less deadly version of Delta. That question has still to be answered definitively. But the number of deaths are very low. So I think the stress on the system would be on the hospitalization side. Because if the cases are very high, and even if a smaller percentage of them, of those people get hospitalized, that will overwhelm the healthcare system. And we are already seeing that in New York and other places. But I do not see a doom and gloom, as to summarize all of that, because we now are very mature from the vaccine side of things to manage a new variant, whether it's Omicron or something even deadlier that comes after that. So not doom and gloom from my side.
Anyone else feel like this is affecting your business or what you might do going forward?
That's just with travel. I spent a reasonable amount of time in the UK, and that's gotten a little more complex. But we'll live with this for a long time. There'll be variants, which it's different than the flu, right? In a lot of different ways, but it's not like it evolves into an entirely new thing. We have to refabricate, you tweak and you move through it. So this might not be optimal right now, but it sure is hell not as bad as it was a year and a half ago. So bottom line is we already hit bottom. I'm not going to spend a lot of time worrying about small variations. I do think, I would prefer to meet with entrepreneurs before I fund them. I've only funded one entrepreneur ever where I have not physically met them before I gave them capital. It was a small personal check. I did it during COVID. I don't have any regrets about doing it, but I'm writing $2 to $3 million checks on average. I'm going to physically sit down with you. I was in the UK. I got to find a very exciting business there. I got to sit down with that founder a couple of times before I left, but it is likely that my ability to see them face to face over time will be diminished. But the thing that I think has changed, not because of the current status, but just because of the way things have evolved over the last year and a half, every VC that would consider a deal outside the country would elevate their concern, right? They would have a higher bar because, I'll give you a quick example. At one of the firms I was with, we were looking at a deal out of Africa, very exciting fintech company. I liked a lot of things about it. We met the founder only remotely on a video, and we knew nobody in the community, and we knew nothing about the regulatory environment. And then I went online and looked, and there is one flight a week that will get you to that town in 18 hours. All the rest require an overnight. So all of a sudden you're thinking about 4 board meetings a year minimum, maybe more, and you're spending, 2 days in each direction. Wow. I'm not saying you don't make the investment, but it really elevates the bar. Today, I think I certainly have a lot of comfort, and I think a lot of others do with, well, maybe if I'm doing a UK business, there's 1 board meeting here, there's 1 board meeting there, and there's 2 board meetings over Zoom. Zoom has been very productive, or Meet, or Teams. 1 out of every 100 is Teams. Interestingly, though, the Europeans always want to use Teams. I don't know why. Microsoft has done a better job convincing them their product is good. But we're on Zoom, and so is everybody else in the world. So, I think I've given up on trying to predict the future. People usually ask, how long will it last? Like, people have been asking me when the bubble is going to burst for the last 14 years. If I could travel back in time, what I would tell younger me is do every deal that you spend meeting all crushed. Like, all those worries you had, none of them come true. So if they didn't come true for 14 years, that doesn't mean they won't come true. But I'm not going to be the one that sits around and pontificates about when, and having vintage variability in your investments is useful. Once the world changes, I'll be a happy buyer and a sad seller. What is that saying about making hay when the sun shines, that sort of thing? So I think you got a job to do. We keep doing it. And other than the fact that I'd like to have more of my, to be honest though, I've had one or maybe two people say no to in-person meetings. They're outdoors. Obviously, I'm in California. That makes it easier. We're all vaccinated amongst the people I've been meeting with. So, I haven't noticed. And the people that I know came back out. So I don't see a lot of reason to change behavior.
Anybody else want to weigh in on that?
Yeah, it's too early. The news on Omicron is lousy, let's admit it. I think the major effect is we're really sick of this, but is it going to change how we're working? Some meetings, some events are getting postponed, of course, but I honestly don't see it affecting, we invest for the long term. It's always hard to time the markets. That's why differentiation, diversification is super important. Stick to fundamentals and you can kind of weather any ups and downs. So I think, to the point, it's vastly different than a year ago. It's highly unlikely we'll see long-term shutdowns, big time school closures and that sort of thing. That's super disruptive to people's lives. But we're going through a bump now, and I think that will last for a month, and the impact will be distraction. We have had meetings canceled because somebody got COVID, even online, companies pitching and somebody had to go deal with the fact that their house now has to quarantine. But otherwise, I think we've gotten pretty good at how to weather the storm over the last couple of years. And there's a lot of good news on the horizon in terms of managing this for the long term.
Okay.
Yeah, I would just agree with the previous speakers. And, there is some COVID reluctance in terms of events, in-person events. And we believe there will be a post-COVID, hard to say exactly when, but travel's more challenging. But yeah, overall, we're plowing through it.
Okay. I'm going to try and share a screen here. I want to show you something. Hopefully you can see global funding by month through November.
Yep.
Okay, I shared the right one then. Wow, look at that. Just look at those numbers. Just look at, where is all that money going? That's tremendous. 65 billion in November globally. And just look at the trajectory, how much that's increased over the last couple of years, according to Crunchbase. So let's talk about the implications of that. Is it a frothy market? Are valuations too high? Are there just more really good quality companies out there? Because that seems like a tremendous increase in the amount of money in the ecosystem. Anybody?
Both your points are true. I think there are quality companies out there. They're bigger than they've ever been. Remember that in 1996, there was not a single technology company in the top 5 most valuable publicly traded companies. And today, 100% of the top 5 are tech companies, all of which were startups not that long ago. And most of which are, there were single, 1, 2, cresting on $3 trillion. So the size and durability and quality of these companies is much higher. Having said that, there's also a lot more money chasing the deals. It's still a story of the top 1%. So the best deals get bid up. They take a lot more capital. I would think of it more as like everything in this world to me is probability weighted, right? We take rational risk in exchange for ridiculous return. And we know that a percentage of our companies will fail. We know a percentage of them will hit, middle level stuff. And we really want to believe, and usually have some that do the tremendous 40 to 100x plus returns that drives this entire industry and business, at least at my stage, right? So
Any other comments?
Probability weighting it, I argue that it is more a battle of risk. The earlier stage you are, the more you've mitigated risk, and the later stage you are, the more risk you're bearing. When you're a late stage player that's putting $250 million into a company at a $37 billion valuation, or one of my companies just raised $250 million from Sequoia to $6.5 billion, which seems inexpensive compared to Databricks at $34 billion. That's when you're taking the highest level of risk, because a macroeconomic correction will hurt you the most. The early investor that came in, seed prices and pre-seed are all over the place. You've got, everything from the classic 1 on 4 still exists to some crazy numbers with these seasoned multi-billion-dollar public company founder startups. So, but the quality is super, super high. And eventually, I think everybody believes the music will stop, but I can't imagine it will during the current administration's willingness to print and spend an unlimited amount of money, irrespective of where and if it can ever be created, by future generations.
Yeah. Rupam, are you seeing the same?
I think, yeah, not much more to add. Larger round sizes and valuations going up. So both of them sort of reinforce each other. If your valuation is 50 million for your seed round, you're probably raising 15 million. I think a part of it is also that given the pandemic and the restriction on face-to-face meetings that we've had off and on for almost 2 years now, there has been a tendency to just invest more in your existing portfolio companies because you know them, you just give them capital to grow. And VC funds typically have sort of a 4-year investing cycle. They have to deploy money. A lot of the money deployed in 2020 went into existing portfolio companies. So VC did not stop investing, but I'm also seeing the same trend: larger rounds, higher valuations, and that partly explains that graph that you showed.
Yeah, I guess we wonder how long that we can keep that up, huh?
I agree with all that. I'll just add another dynamic we've seen is simply an allocation from institutions that need to earn a certain percentage, and fixed income's not going to get them there, right? So increasing allocation. So there's certainly the flywheel effect of there's been an exit, we have to reinvest the capital, but also I think allocations are going heavier, have been going heavier towards venture private equity in order to seek out the returns that they need to get their bonuses and drive those long run results. Will that hold? I'm hearing the risk is becoming a concern, and they want to start seeing capital come back more quickly, just to balance the beta a little bit.
That's a good point, because I've heard people say that last year people were nervous about the public markets, the stock markets. They're nervous about real estate, crypto, who knows? So that kind of made, venture investing look a whole lot more attractive, venture and private equity. So maybe that's part of what's happening. Yeah. Anybody else want to comment on that?
I mean, I'll just add that, in the macro environment, you've got this, apparently what you have is you have one part of the government printing money and selling it to the other part. And that, as I recall, didn't happen in the 2000, .com era. So, maybe it'll be a bubble that'll burst at some point. I don't know when, or maybe it's asset inflation. If it's asset inflation, all assets, I heard one speaker say this in another panel, if that's what's happening, then, maybe it won't burst. Maybe it'll just flatten, so hard to say. And who knows when the music stops. One would think at some point it will, but right now it's not.
Okay. So I just want to remind everybody that we are recording this. A recording will be circulated. If for whatever reason you don't get it, I'm going to post the URL where we put all of the recordings from this panel as well as prior ones that you can access forever and ever, as long as I'm around. But let me shift topics for a minute. Hot off the presses, I just got this from Bob Carr at Link SV this morning about the M&A market in 2021. And 2021 isn't over yet, of course, but global M&A topped $5.5 trillion last Thursday, including more than $2.4 billion for U.S. targets. And it's a record-breaking year for everybody, including private equity, including venture-backed companies. So I want to just hear it anecdotally, straight from the horse's mouth. Did you have any really big exits this year? You've been seeing a lot more venture-backed exits. Is there more consolidation? Is there more liquidity for I guess, your partners? Anybody?
We had 3 IPOs, which is different than M&A, but certainly a lot of M&A interest in the portfolios as companies go to raise their next rounds. Some, are appealing, some are not. Personally, my husband's a serial entrepreneur. His company was acquired by a company called OneTrust when he was raising his Series B. Definitely a lot of M&A as companies are looking to accelerate their growth, to be able to hire.
Jennifer, were those IPOs or SPAC deals?
They're IPOs,
Oh, really?
Amplitude, yeah, DigitalOcean and Airbnb. So we do definitely see a lot of SPAC activity in terms of a potential exit path for some companies. I'd say kind of an interesting trend though is when they meet with us, so many of the companies pitching seem to think we want to hear that they're going to do an IPO or a SPAC. And they'll say, we'll consider M&A along the way, but I think they're getting conditioned to hearing from VCs that we want unicorns or whatever's after a unicorn, and that they're going to have to, really aim for the fences. So that's an interesting trend, but M&A has been very active. I've been telling companies, if you're not sure what your exit's going to look like, now's the time to, talk to your banker, court those partnerships, start building those ecosystem partnerships, because that's going to be your acquirer. If you can't get acquired in this market, you're going to have to do a lot of really hard work to get to a point where you can get acquired, and that could be years out. So I think that will continue for a bit.
Yeah. Anybody else see a lot of activity in your fund?
Well, to give you sort of order of magnitude, now keep in mind, I've been investing for 14 years in seed before I started this fund. So I'm looking at that corpus. And out of the 109 companies I backed over the last 14 years, not all of which were obviously still active going into the year, I've had 4 companies go through the SPAC process, 2 are live, 2 are coming out in Q1. I've had 2 companies sell for like 600 million a piece. So, sort of what I think venture thinks of as middling. And then maybe 4 other companies that sold for, okay transactions below middling, and then $1 billion transaction. So, that's 1, 2, 3, 4, 5, 6, 7, 8, 9 liquidity events of some sort out of a portfolio of whatever percentage of my 109 were still live. Now that feels bigger than most years, certainly, but not by some huge spread. You see transactions happen pretty much all the time because these companies are built. Look, if you think about it, irrespective of what you go in with as an intention as an investor, investors only win if companies get liquid. There is no, I tell this to entrepreneurs all the time, if you want to build a lifetime company that goes to your heirs, venture's not for you. Like, without liquidity, what are my LPs going to say? Oh, look, I've got a fund. It delivered my first 3 years, 08, 09, 010, 30 companies, about a 13.6x fund. There's still 1 company live in that group. It makes a little money. The entrepreneur keeps going. Well, that's great for him, but it's absolutely pointless for me. There's no market. It sort of sits there. And that's okay. That happens. I'm perfectly fine with the outcome of the fund. But, ultimately, investors invest with the intention of liquidity at some point. Now, sort of to Jennifer's point of everybody pitching with, I want to do an IPO. Bluntly, if I don't believe you have a path to an IPO, I'm not going to fund you. I have absolutely no interest in some, well, look, let's face it. Most of the time I'll have 4, 5 public companies after 14 years. I mean, I'd certainly like a hell of a lot more, but obviously there's a lot that didn't get public, and I've done really well with ones that haven't. So M&A is a frequent exit when you don't get to the promised land that you're shooting for. Now, having said that, M&A during an IPO and post IPO is also a big part of the business, right? Because that's when sort of the market has priced you and someone else can outbid the market. And I mean, I remember I was at 2 different funds that had an investment in MuleSoft. MuleSoft went public. It was a great company and got bought later as a public company while still losing money, if I remember correctly. Phenomenal business. Great problem. They would have had to throttle over. So, M&A happens all the way through the day of the IPO and well after it. And I will make one last point. Remember that the buyers, particularly if they're buying for stock, I had one of my companies, Divvy, got bought for $2.5 billion. It was a mix of stock and cash. That was a company I funded while I was at NEA. So I forgot to add that one to the list, but that wasn't one of my personal investments. That was an investment on behalf of NEA. So a very nice transaction. They were bought by Bill.com. Now, a big chunk of it was cash, but they're also being bought by a company that's trading for one of the highest SaaS multiples in the public markets. And my point would be, if you're trading for sort of phenomenal SaaS multiples and you can buy a company that helps you grow and delivers revenue, like, it makes a lot of sense. I mean, there's even an arbitrage to it when done well. It used to be that mergers didn't tend to work out well, but I think in technology, mergers can work out much better than they have historically because of the ability to sort of create a multiplier effect into. It's the old model of Cisco would buy something and immediately 10x their sales because their sales team was already in every business that needed to buy that product, and they just could magnify it by putting another product in the bag. And so, I think public companies in the tech space have become tremendous acquirers. Benioff has done a great job, right? So I think that'll continue until stock prices subside.
Yeah. How about the others here? Exits?
Yes, some of my companies are going through an IPO exit. This is from my previous fund. The current fund was raised recently, so there's still investments happening. A lot of up rounds and a few exits in the pipeline. No exit yet.
Yeah, I'm a little worried about those up rounds, is what you were saying about having to do a down round later in this environment. So we'll see. I just saw a down round yesterday, and it's like, uh-oh.
Yeah. Now, one of the things we do is we try to sell out in those up rounds where we think the valuation is going too high, and there is way too many term sheets for a very high Series C round. We sometimes try to sell out our stakes.
When you say sell out in a secondary sale?
In a secondary sale.
Let's pause on that for a second, because that's something maybe it's my imagination. It seems to me I'm seeing a whole lot more secondary activity now in private companies than ever before. It's just a lot. Is that me, or are you seeing that too?
Yes, I have. In fact, typically, I think it's a function of a lot of demand for, let's say, a 50 million round. There might be demand for 70 million, and there might be someone who has already made 10x on that investment. They are happy to sell. So founders also like newer investors, because newer investors give them a longer runway. And I think it works for everyone. If there is demand, sometimes they supply, especially investors like us who go very early. We are typically writing sometimes even friends and family checks and pre-seed checks. We would love to get some sort of a 10x type exit in 3-4 years if it's possible.
Yeah.
There's an explosion of secondary transactions going on. When I was raising this fund, I decided I wanted to put in a 10% GP commit. And that's a big number, and it's a big number for me. I did well, but I didn't do so well that I can do that without blinking. So if I do that 3 funds in a row, it's over 50% of my liquid net worth. And I really wanted to get it to 50. So I started looking at how can I get liquidity, and guess what? You can get liquidity by selling your winners. And sadly, I knew the day I sold some of these shares that I would regret it. I had a company that was valued at 1.2 billion that I constantly had people asking to buy from me. I sold some shares at 2 billion. I knew I'd regret it. I knew it would get marked up. I love the company. I love the founder. And 3 months later, he raised at 6.5. I don't regret that I did it, because I did it for reasons that are important to my life and family and just maintaining balance. But, it's the secondary market is great for super premium product. Now, having said that, there is also a certain amount of FOMO in venture where every round has gotten so big and demand is so high that you can often sell into a round purely because of the demand on the other side for more ownership, even when you're not excited anymore. I've only had this happen once, but I was very concerned about a company. Somebody dropped a huge term sheet on them and they said, we need more shares, and they tendered for more. And I was like, well, I asked my entrepreneur and they said, I'd love it if you'd sell. It would really help the round. I was like, great. I made 6.5x my money, and there was a crushing down round a year later. So unfortunately for me, because I still held some shares, it went as expected. I really don't like to be right when I'm predicting failure or any sort of doom and gloom. It's just, I would much rather be wrong. But sadly, and it's funny because these days, some of the folks that are bidding on companies, some of these companies are so competitive, they're bidding before they meet them. And I can see reasons why that's valid. In some cases when they're further evolved, but when you go down to a Series A and you're bidding on something off of what you saw out and about, like, come on, what kind of risk profile is that? But there's just such, I can't tell you how many emails I get. Hey, would you be willing to sell X, Y, or Z? Whenever they know you own X, Y, and Z, they want to know if you'd be willing to sell it. And
well, not only
I would love to just hold forever in everything I do.
Yeah, not only you, Ben, but founders are selling a lot in secondaries, it seems to me now. And again,
that's more, I think it has become more of a norm than I would like. I really dislike it on the A. Thereafter, I'm not irrational. When I took my company public, okay, my underwriters said no to me about selling any shares at all. And I was like, are you kidding? I just want to have enough money to buy an apartment to live in New York City. And they're like, no, bad signal. Oh, give me a break. So I'm not opposed to people, like we had some founders that wanted to take secondary liquidity to pay off their student loans. No problem. They actually wanted to round up from 100,000 to $1 million. No problem. You want to buy a house? No problem. I would prefer to see it at the B. But I've started to add a clause, I will say this publicly because I tell every entrepreneur I talk to about it when I get to the point of a term sheet, that if my founders, remember I'm a seed guy, if they decide to sell a chunk of their portfolio, I have the right to sell an equal percentage chunk alongside of them. Usually I'm not going to do that because usually they're just doing it to buy the house, whatever, no big deal. But sometimes they're selling because they've lost confidence and for whatever reason, they got an escape clause. And I have been in one or two of those situations and I would dearly love to have sold alongside. I could have recovered my whole investment, but instead, nope, none for you. And then, 3 years later, the company goes to zero. So there's lots of reasons for founders liquidity. A lot of them are legitimate. As you get later stage, it sort of gets a little crazy, but as long as they're not doing the thing that I do find honestly offensive, which is, hey, I just want to sell, it's a big round. Why don't I sell $25 million of the shares? And then the next board meeting, it's, by the way, I'd like a re-up for another $25 million of the shares. So you basically want to be replenished the shares you sold because you made the choice to sell them.
That's a good one.
that I think is just totally and completely inappropriate. Like, you're going to win huge. Let's not nickel and dime us because you've decided to get liquidity and then reverse it out through the good graces of your board. That just feels piggish to me.
Yeah,
Bulls
okay.
make money, bears make money, pigs get slaughtered.
Jennifer,
I can offer some advice to people building pitch decks and they're thinking, ooh, maybe I can get some liquidity. I'm finding it's a tool used by companies that want to win the term sheet. They're like, okay, and PE is doing a lot of this, by the way. But in your initial pitch, don't say you're hoping to take money out if you're the CEO. Wait and see how it evolves. We're still going to look at how much ownership, is there skin in the game? To Ben's point, we don't want to then see you come back and ask for stock options to replenish it. We'd want to make sure it's enough that you're happy and your spouse is happy, because that's sometimes where the stress is coming. It's the family. The biggest angel investors in the world are the partners and the families. When you think about it. So, but don't, I've seen a few fatal pitches where they include it in the first pitch and then it's like a pass right away because it sends the wrong message about commitment.
I'll bet.
There's a really important point here I want to emphasize buried in Jennifer's awesome comment. The best investors, in my opinion, and I guess I'm mirroring my own belief system as a longtime entrepreneur, want their entrepreneurs to be well positioned to win big when the win comes. I am working right now with a company where their early investors took too much from them. And I'm concerned. I mean, they're like two co-founders raising, after I invest, we're going to raise what I would call a US Series A. It's an international company. They've raised a Series A, but somewhere else, and it's smaller. But, in total, they've raised $12 million or so. Anyway, they're both sub 10%. That's too low. Too early. So what I've said is, look, if I'm going to give you a term sheet, and by the way, it's not my job to fix it out of my shares, is my view. It is your investors that took too much out of his job. So what I am going to do is fund you at $X, and I'm going to ask for a increase in the option pool, real numbers, call it to 15%. And I, out of that 15%, want each of you to get 2.5% back. Now, for anybody that doesn't work on term sheets, all that stuff's coming out of the hide of the other investors, not out of me. It's coming out of the pre, not the post. I also, and I haven't figured out if I can do this, want to put in a reward structure where if they really crush, they get even more, but that's going to have to be done by the board, and I'm probably not going to go on that board. But, I think the best investors care a lot about whether their entrepreneurs have enough ownership. I remember still to this day, the first time one of my entrepreneurs came to me and said, oh, I don't know, it's hard to stay motivated with this ownership. And I was like, are you kidding me? You did every one of those rounds, man. I'm like, I told you were taking too much dilution. He's like, yeah, but I'm down to 6%. I'm like, oh my God, these are self-inflicted wounds. How do you get, what, it's my problem? But it is. If your entrepreneurs get too skinny over time, it causes challenges. I'd rather fix that at the beginning as best I can. And I have in more than one occasion on boards fixed it after the fact, which obviously comes out of my equity as well. But I think it's super important your entrepreneurs be well-funded and have a decent ownership. And to Jennifer, part of what Jennifer had inside of that was what I think entrepreneurs don't understand. Investors really care a lot, at least the ones I know, respect, and trust, about how their entrepreneurs are treated and how they are situated. Unfortunately, I think at this point, sometimes people take advantage of that and push really, really far. And it's sometimes stunning how far, but they got a lot of coaches whispering in their ears all the tricks they can play.
Yeah.
Those people
Well,
aren't
I've seen that a lot, and it's worse now, I think, because of the rise of the safe, because entrepreneurs can sell a lot of their company and not realize it until they get to that financing. And then all of a
That's a good
sudden,
call.
someone like you, Ben, will say, look how
That's
much
right.
I gave away. Jim, you've been so quiet down there in the corner. I know you got something to say about this.
No, I'll just I agree with the other comments. There's a lot of it's much more reasonable now than 15 years ago for entrepreneurs to want to sell a little bit. I mean, that's that with the valuations and so forth. And yeah, to Ben's point, just you got to have some liquidity, and it's taken longer to exit, so at least it has been. So yeah, I would agree with those points. Yeah.
Okay. Let me move on. And in the time we've got left, I guess I'd like to hear what is really hot. I mean, we've got mostly entrepreneurs here. I know this group. I know why people come. They want to know what you're investing in, what you're excited about, what companies they can come to you with. What are you really excited about? And Jim, I'm going to stick with you to just get us started on this.
Well, as previously mentioned, we do enterprise deep tech hardware, and we think that's a great space, and has a lot of future. And if and when there is a move back to basics in particular, that'll really shine. So we like that. There's one of our deals is involved in AI, and there's a little bit of a AI may be a little bit overhyped, and we found in one of our deals that depending on the size of the training set, AI doesn't solve everything. And so sometimes in one of our deals, you need hardware to solve it, and you can show it by the size of the training set. And so as one guy said, in another year, VCs may not so quickly fund anything with X plus AI, so that's something might happen in the future. So but we think we're basics type of people, so we like our space, and we think it's got a great future.
Okay. Rupam, how about you? What's really exciting you right now?
Yeah, so we have a very stable thesis for this year. We like to invest in what we call exponential technologies. So artificial intelligence, robotics, machine learning, some quantum computing, AR, VR, blockchain, and biotech in sort of the life sciences vertical. What we are most excited about is our real breakthrough innovations in these areas. Typically, all of those breakthrough innovations can be traced back to some researcher or professor in some university. There are a lot of professors who are now commercializing their research, which is where we are most active in. In fact, all of our 7 investments that we made this year, 6 of them have been led by professors, and the 7th one has been led by a PhD. So those are the things we like: real fundamental disruption in these technologies. One of our companies is in the artificial general intelligence space. Another one has plans for a 256-bit quantum computer. So companies going for a big leap in innovation and really early rounds. So that's what we remain excited about, and we feel that's a good niche given how Series A, Series B, Series C valuations are going up. Staying really early valuations are still sane. And as Ben said, there is more risk in doing a $2 billion Series C round rather than a $50 million seed round. So those are some of the areas we are excited about.
So Rupam, sounds like you'd be a little more inclined than most VCs I've talked to invest in fundamental research or fundamental science, I would say.
Yes. And in fact, we are so much inclined that in fact is the core thesis of our venture investing. Out of me and my partner, we have created a personal foundation. We also give grants, but that's only from our own money and GP profits and carry. So we nurture that network, And we are willing to invest our personal money and our fund money in that network.
Okay, good. So I want to remind people, if you have questions, go ahead and type them into the Q&A box. We're going to get to them in about 5 minutes. Jennifer, same question to you. What do you think is really hot right now in the investment space?
Right. Well, in terms of the things we look at, certainly AI is having kind of a rebirth, a resurgence lately. Zero code, low code, I think where they've achieved product market fit and have found what the use cases are that their client base is willing to pay for and deploy outside of pilots. So our company has really managed to productize something built on top of AI is interesting. Cybersecurity continues to be a lot of opportunities there, not an easy space to wade through because it's very fragmented. But it's always full of innovation and lots of problems to solve there. Blockchain, I think that's going to be a really interesting segment this year. FinTech. We don't do a lot of HR tech, marketing tech. We may not be as deep science as Rupam, but definitely want to see moats and defensibility in those areas. So I think those are the hottest ones. We're also seeing a lot of activity around two interesting areas. One is DevSecOps, right? DevOps, developer tools, how to really increase the efficiency of development teams, reusing code and so forth. And another thing is communities. A number of companies pitch us, and part of their value proposition is how to help their customers build and own the engagement and community with their customers more directly. Whether it's, say you're a Tesla and you really want to own that customer experience, or Starbucks, because they don't want the social media giants to continue to really take in on those relationships. So there's an aspect around community building, and the tools and applications that will get you there is an interesting development I've seen. I wouldn't say it's something we're specifically out there looking for, but it's a common theme that's coming up in a lot of pitches lately.
Okay. Thank you. Ben, what about you?
Well, it's funny, having been doing this for so long, I often have entrepreneurs that don't make it. And you'll get why I'm telling you this story in a second. But what'll happen is, my attitude is simple. I know that I might lose all my money in any investment, but I'm not looking for a refund. So if you spent 50 cents, 60 cents, 75 cents out of the dollar investment and tell me you want to give me back a quarter, my answer is, why don't you just figure something else out? I don't love pivots, but it's better than getting my quarter back. I'd rather have you try. And so usually they'll say, okay, let's sit down and talk about what we can do. And I'll say, great, why don't you just do whatever makes you happy with thought? Like sit on a mountain, drive a car, go for a swim, and then come back to me with your list and we can go through it. And usually they come back with me either with a list or not, but they start with, can you please just tell me sort of what's hot now? Exactly your question. And every time anybody's asked me that, I said, it is the wrong question, because what's hot now is probably too late for you. It's what's going to be hot later. And the reason you might figure that out is because you'll discover something specific to you, some learning you had, something you discovered during your failure, something you've seen about the world that you want to change, right? That's what I'm interested in. I care about entrepreneurs that make me say, wow, I want uncapped upside. I want to believe every single person I fund could be a future public company. I don't care what category you're in. I do not typically invest in security, med tech, or core IT infrastructure. The first two, because I don't have the domain expertise. If you don't wake up worrying about security every day, good luck investing in it. And the last one just bluntly bores me to tears. I had to do way too much of it as an entrepreneur, and I really never want to do it again. And having a conversation about some deep in the stack, blah, blah, blah. It's like, I mean, it's a great way to make money. Don't get me wrong. It's just not one I enjoy. So, but quickly, like here's companies I've funded in the last 6 months. Plant and bioscience-based tuna. Phenomenal. So good. Nobu just placed an order for raw tuna that they make in a factory. Awesome. By the way, $1.2 trillion industry for seafood around the globe, and he wants to take half of that. I've got a company that does SaaS for real estate, so they can speed inspection so you can get paid in 4 days instead of 82. And they have a fintech component baked in. And on and on and on. I will say that fintech is everything now. People are baking fintech into every possible business, which makes a lot of sense. I started funding fintech in 2007. I thought that space was fully inked in, but I'm wrong. There's plenty of white space left there. Obviously, Web3, blah, blah, blah. But, I have a company that's an NFT company. Isn't that great? I funded it 6 years ago. It made its way to this over time. I just have on the Tenacity Venture Capital LinkedIn page are 24 endorsements from entrepreneurs telling other entrepreneurs why they should take my money. Well, actually 23. One is telling LPs why they should give me money. And one of them, a woman that started a company called Block Cypher, was saying, well, when Ben invested in my blockchain company in 2014, and it wasn't until I watched that video that I realized I invested in a blockchain company in 2014. I knew I invested in her. I just didn't know it was that long ago. But she still hasn't figured out what to do, right? So just because blockchain was big, I mean, it's been big and it's been big and it's been big and it'll continue to be big. I don't think it's the next web, but that's a different argument. So I think it's really personal to each person. You need to find the thing that you've discovered. I think entrepreneurship grabs you by the throat. I think ideas find you. I don't think you find them. It's one of the challenges for many of the entrepreneurs I see spin out of classic firms, you know, a Google or whatever, engineering mindset. They're trying to solve for what's the right thing to do as an entrepreneur. And sometimes that does work, I will admit. But the entrepreneurs I love are the ones that found a problem that they could not get away from, that they woke up in the morning thinking about. They couldn't stop. It came to them in the shower, I don't know, and it chased them down, and they now have to do it. That's what's hot now. It's whatever chases you and grabs you by the throat and insists that you do it.
Okay. Well, on that note, I've got one last question before I open it up to Q&A. How do people get a hold of each of you if they want to hear more about you? Ben, since we're on you.
Oh, sure. So as I mentioned and plugged in the site, I run pitch-ben.com. Anybody in the world can pitch me a 1-minute video pitch. I promise you a response. It's almost always feedback. It took 300 pitches to fund one, but I did fund one. So I'm looking to fund a second one. I also answer all the inbounds I get from LinkedIn and Twitter DMs. I promise to read every email, LinkedIn and Twitter that I get. I will say if I don't respond, it wasn't because I didn't read it. It's because it wasn't a fit for me. And I'm not going to write 1,000 no thank yous a week. I'm just going to move on. But I will read them all. Any way you want to get to me, I'm there.
Okay. Rupam?
Yeah, LinkedIn is a great way to connect to me. So I will put in my LinkedIn profile in the chat box.
In the chat. Okay. How about you, Jennifer?
Yeah, there's always LinkedIn. If you're raising a Series A, maybe a B, and you've got some traction, product market fit, feel free to send a deck to dealflow@mighty.capital. I promise it gets read. And, you know, similar to Ben, we read and look at everything based on the volume. We can't always respond, but I promise everything gets looked at.
And Jim?
Yeah, similar to others, LinkedIn is great on some of the Good Sweet Ventures, and we can't always respond to everything, but you know, we read them, and we love entrepreneurs.
Okay, awesome. Well, since you love entrepreneurs, we're going to take a few questions from some entrepreneurs now. So our first one here is with the CPI being record high, how do you see inflation affecting the VC landscape? How does this affect your returns? That's a really good question. Does anybody want to jump on that? Oh, you got to be concerned about inflation.
I mean,
Go ahead,
concerned,
Rupert.
sure. But I remember once one of my entrepreneurs reached out to me and they said, this Greek debt situation. And I was like, really? He's like, yeah, I think there's a material risk of default. This was years ago. And I was like, okay. He said, what should I do? It's like, well, let me ask you two questions. Do you have any control of the Greek debt situation, or do you have any influence? If you don't, move on. Like, what are you going to do about it? You know, you're going to buy tips to save yourself off of inflation. I mean, certainly there's a lot of, you could talk about this topic for many hours and scare everybody away with the fact that, you know, we're about to see if we do pass whatever version of Biden's pork-filled monster spending Godzilla of all bills, although, you know, half of it's legit and half of it's pork, but still, that's still a solid, even politicians in his party acknowledge $1 billion worth of pure pork. Okay, so you pour all that pork into the US economy, construction. There's 100,000 unfilled construction jobs right now that pay 6 figures. Those jobs are going to get filled all of a sudden when you jack up the amount of building we're doing. I'm not anti-infrastructure. I think infrastructure is great, but those costs are going to go straight up, right? When you have supply and demand, when you have no increase in supply and massive increase in demand, it doesn't take a rocket scientist to figure out where that goes. But the way I think about it is that just means more opportunities. The real estate market, the construction market, there's so many opportunities there. I can't control inflation. I can't predict inflation. I didn't choose to become an economist. I'm not a pundit on CNBC talking about economics. I'm a pundit on CNBC talking about entrepreneurs, right? So I think that while it is concerning, I just fundamentally don't see how I can have any impact. And therefore I need to, it's the whole me worry. I mean, can't do anything about it, then move on and focus on the things you can.
Right, Rupam, you were about to say something.
Yeah, I think I sort of echo Ben's view on it. If you are a technology investor, technology companies have a different sort of dynamic to inflation. They can keep fixed costs or fixed prices while they can pass on prices to their advertisers wherever their revenue streams are. So I think at the very early stage, it's a non-concern for us. Perhaps investing in a very late stage company, which is consumer facing, which is influenced by inflationary forces, it might become relevant, but not at all for us.
Okay. All right.
Yeah.
Jim, okay.
I would just agree. And there was a professor at Caltech of economics who said that they do microeconomics, but they don't do macroeconomics. The error bars are too big. So very, very hard to predict, inflation. But having said that, if a successful startup has a 10x return, 50x, 100x, that's going to blow through inflation type of issues. So that's why, it's a concern, but, not as much.
And particularly if they don't mess with QSBS, which it seems like is less likely to get messed up.
Well, actually, the current proposal is to limit it for people making over $400,000.
I thought that dropped. I thought it was just a 50% reduction.
It's a 50% reduction if you're making over $400,000.
That's fine. Like I said, bulls make money, bears make money, pigs get slaughtered. 50% is where it started. 50% is fine. Just don't take it away. Don't take away the incentive. We were talking about this earlier. I think it was Jennifer's point about how, liquidity and then it needs to be reinvested. You know how much incentive I have to reinvest money when it was QSBS and it hasn't hit the 5-year mark yet? I'm running around like crazy. I'm already seeing an unlimited number of pitches and I'll work till 2 a.m. to find a place to put that money to work. Doing things that are anti-reinvestment is one of the, I don't want to get political here, but like how do you encourage an economy to grow by attacking the things? I mean, I don't love the real estate community. I've never had a good relationship with a landlord, but I don't like the idea of taking away their ability to be motivated to reinvest all their money as soon as they have a sale. It's all good. More growth, investment is growth. That sorry, I have to rant for a second. 49% of the jobs in the United States come from SMBs, right? And 50% of all financial transactions. What is another name for SMBs when they start? Startups. So let's make sure we support the things that support startups so those jobs can continue to grow. This is not the world of back in the day when, what was good for Ford or GM or whoever it was good for the planet. It's what's good for startups. Let's encourage startups. Let's make sure this, you have the ability to influence anybody. I mean, we can all make one call to a congressman and say, hey, don't screw with helping the startups.
Yeah, let's pause on that for the audience. The QSBS, that's qualified small business stock. That's provision in the law that allows an investor or even a founder, anyone who buys stock at original issuance, to exclude up to $10 million or 10 times basis, provided you hold that stock for more than 5 years and you acquired it after 2009. The provision that was introduced in the House was to cut that to 50%. By the time it got to the Senate, it was to cut it by 50% for those making over 400,000. The Senate report, which came out last week, did not mention it. So presumably they're leaving that alone, but everything's up for grabs. Everything's in play. And, I don't know if we can count on Joe Manchin to keep stopping some of these proposals. So keep an eye on that one, because Ben is right. That is a huge deal. That's a huge deal if QSBS goes away. Hey, next question.
Oh, and by the way, I do want to make a point for the entrepreneurs in the audience that think a safe is the right way to go. There's a lot of reasons why the convertible note is not good for when it favors the investor. Safes don't favor the investor, and they fix most of those issues, but I still don't love them for many, many reasons, which we don't have time to go into. But at a minimum, the investor is not getting QSBS treatment started until you turn it into an equity round. So I get why somebody writing a $50,000 check or some amateur player wants to do a safe. It's easy. They don't have to negotiate terms, which, I think is a weakness. But, if someone's going to write you $1 million, $2 million, $3 million check, understand that they're, even at seed, that they're likely going to want to do an equity round if they're thinking this through. I mean, the tier 1 seed investors I know all want you to do an equity round for many reasons that are your benefit and to ours. So don't hide behind safes. Speed, quality, price. Choose any two. Guess which the safes choose? Speed and price. Let's focus on quality.
Yeah. By the way, on that, for those of you founders that go online and download the forms, especially the SAFE form, there is one floating around out there. I'm not going to say whose, but it has a big clause in there that says, we all agree that this SAFE is treated as stock for federal income tax purposes. That's great that you all agree. The IRS probably doesn't, just so you know.
Very interesting.
All right. Comment on that, Rupam?
No, I was just interesting. That's
Okay.
I agree. Yeah, safes are short-term safe for the entrepreneur. Long-term, they are not good for entrepreneurs and not good for investors either.
Yeah. Okay. Next question. As investors, how do you reduce bias and ensure high-quality decision-making when you're under time constraints all the time? That's kind of a loaded question. I guess, are you under time constraints?
Well, when someone's trying to create FOMO, they'll tell you there's a time constraint. We have a lot of process around our underwriting process. And the bias, one thing we do, we make sure that all three GPs are not on the same due diligence team. So that, there's always that voice of challenge, right? It's really important. And we also stick to the playbook on how we're going to do this diligence to make sure we're not skipping process, make sure we're getting the information we need to do. The time, we rush it to the best we can if it's something we really need to get into. But if we're ever pushed in a situation where it's like, this is closing by Christmas, are you in or you're out? And we haven't been able to talk to the lead investor if we're not leading, talk to a customer, get their financial statements, we will not shortcut the process. We stay very disciplined in the long run. So, and if we've got several things on our plate at once, which we've had this year, and you're going to push us on time, that you risk, that we're going to rank you and kick you out and prioritize the other 2 or 3 deals that we're looking at to get through. So we really respect our time, the entrepreneur's time, try to finish diligence in, say 3 weeks, maybe, which is short. If it's an equity round at a stage A, Series A, Series B. But a lot of that is in the hands of the entrepreneur and how much are they controlling the clock and getting us the data that we require to do a good due diligence. So.
Mm-hmm. Okay. Anybody else want to comment on that? That actually is a really good question. With all the money in the system, chasing the deals that are out there. I don't know if you remember, I'm extremely old, so I remember before the .com craze when people were coming in with less than a pitch deck and getting funded really quickly with almost no due diligence, just a wing and a prayer and an idea. It certainly isn't that bad now, I don't think. But I
think that's changed. We ask, is this a frothy market? And we compare it to .com. There are days it feels like that. Right before the stock market meltdown, I was starting to feel like it was March of 2000. But I think the quality has gone up substantially because of lessons learned a little bit. So fewer things are getting funded on an Excel spreadsheet dream than used to be the case. The diligence is generally tighter.
I will just tell you from experience, having gotten to know well over 300 VCs and helping 100% of the 109 founders that succeeded in raising a Series A raise their Series A and working on back channel constantly. Like the number one job I have is to help my entrepreneurs raise an A from the right person. The right fund is important. The right person is far more important. I think a lot of entrepreneurs feel like, well, first of all, you do have to keep pressure on a fundraise. You've got to have some time pressure. Otherwise, people get lazy. People think they have more time. People negotiate more. But to Jennifer's point of having enough time to do the job, when you come in and it's like, we got to have an answer on Monday, you destroy a lot of possibilities. Yes, for the absolute perfect deal, not the 1% founder, but the 1 basis point founder, you come in on a Friday and you're saying you're going into whatever, Sequoia Benchmarks partner meeting on Monday, and you will need an answer by the end of Monday. People work through the weekends. Yes. But are you that person? I mean, you don't want to be Zuck. You already are Zuck. Maybe not. I mean, just statistically, probably not. So if people don't have the time to do the work right, the default will be the following. And I got this all the time. Ben, we love the company. If we had more time, we might be able to give you a term sheet, but we just can't do it under this timeline. Why? Well, guess what? It's not just you, it's a partnership. You won't look like an idiot in front of your other 6, 12, 18. I once took a deal in front of 28 other partners. Hey, how was your diligence? Well, I really have a gut instinct. By the way, I do think gut's incredibly important to investing, but I have a gut. This is going to be great. Really? You want us to write a $12 million check on your gut alone? Well, the real answer, if I was being honest, is yes, I do. But that's not how the process works. Venture is grown-up debate club. Nobody knows the answer. It's all about the future. It's all uncertain. And sometimes if you're not a good enough debater, you lose. And sometimes if you're a phenomenal debater, you win when you shouldn't. So if people don't have the time to do the work, it's hard for them to be your advocate. It's hard for them to make good decisions. And at the end of the day, remember, you are entering into a marriage, a 7 to 10 year marriage, now more like 12 sometimes, and it comes with a one-way prenup. And you as the entrepreneur don't control that prenup. So don't you want to make sure you're happy with your future, business spouse? When it goes bad, it goes really, really bad. It doesn't happen that often, I will admit, which it makes me happy that it doesn't happen as much as it used to. But, spend the time. The time's important to you as well. Creating an artificially short process to show that you're the super hot star of the day, I think is a dysfunction, not just for the investors, but for you also. You really need to know these people. You should be diligencing them, by the way, at the same amount that they're diligencing you. So that should take.
So I tell people, that's right. I tell that to founders, Any other comments on that before we move on?
I think I echo what has generally been said. We find ourselves in those situations very, very, very frequently because some of our entrepreneurs are really bright luminaries in the science and research area, and some of them coming out. Typically, they get very term sheets from large VC funds where putting in a 5 million check for them is actually a gut instinct investment because it's too small a check for them. So they write those checks or they write those term sheets very quickly within 24 hours. And sometimes we have to respond to them. The way we have gotten around that is, of course, that the entrepreneur needs to be in that 1 basis point, 1 percentage point type of sort of that percentile. However, if they are, and if we find ourselves in that situation, we try to get to those founders before they even launch the company. And this is sort of one of the theses of our funds, that get to people with fantastic research before they are thinking of founding a company, and build a network with them, so that once that crunch time comes, you can at least make an informed decision because you've known the founder for some time.
Okay. Here's a question. These high multiples and valuations, do they exist in cycles? We're expecting this to continue. Is this the new normal, I guess, is the question. I guess, first of all, are we having high multiples and valuations now? And if so, is that the new normal? Anybody want to jump in on that?
Well, I will comment that people have been complaining about the prices of deals since I started doing this 14 years ago. I remember in 2008, 2009, remember I was one of the first 3 people to do seed. I was talking to this VC and he's like, you seed guys are driving me crazy. And I was like, why? And he said 2 things. He said, 1, if I have to write another check to Josh Koppelman, who ran first round and who had a lot of companies would get bought by his startups, I'm going to puke, because he didn't like the idea of paying 20, 50, $100 million for some little startup that Josh put $1 million into. And the other thing, and this is a literal quote, you're pricing me out of the market. I had to pay $8 million pre for a Series A. Really? Man, I'm so happy when I can pay 8 pre as a seed investor. Pre-seed, it should be cheaper. But, it's like the complaints. Actually, there was a great quote from Alfred Lin, who I like over at Sequoia, about how he was complaining to Mike Moritz about how prices were too high. And that was vintage 2009, right? They just keep getting higher and higher and higher and higher. A buddy of mine at Benchmark told me they didn't take a year off, but they did a lot less deals because prices were too high. And that was 6-8 years ago. So going back to telling younger me to do all the deals, like I believe it will end eventually, but so far it hasn't. I wrote a story once for TechCrunch about winter is coming, build a fire, encouraging entrepreneurs to shore up their balance sheets with extra capital. Winter never came. Like a brisk fall hit for like 2 weeks. And then it went away and prices went even higher. I mean, the conversation of, oh my God, these prices are ridiculous is eternal at this point. I mean, 14 years is an eternity. And don't get me wrong, I launched a company on Black Monday. I lived through 9/11. I lived through 99. I lived through 03. I lived through 08. I mean, look, I've been through a lot of very traumatic times as an entrepreneur, as an investor. Things change and they hurt really badly when they do. But right now, it's just like, man, I've never been in a cycle that's lasted 14 years. Australia apparently lasted longer and has continued to. So I don't know, that gives me hope.
Any other comments on that? No. All right. Okay, next question is, as top VCs are moving both in the seed stage as well as public markets, I guess we're talking about that Sequoia memo that we saw recently. Do you see behemoth VCs dominating in the next 10 years? And what should startup entrepreneurs use to take advantage of the trend? I'm going to guess you'd disagree with that.
No, actually, we are sort of on that trend in a way. In some ways, we were there 1 year before Sequoia's memo. Our fund can invest in public equities, startup, and cryptos. So the reason we did that was that because we invest in really early companies, we need to support them for extremely long periods of time. At least we need to be ready for that. So a public investment pool provides that warehousing of capital where we are not forced into 7 or 10 year fund cycles and forcing companies to exit or forcing ourselves to exit those companies because the fund is coming to an end. So the public pool of capital provides almost it is an evergreen structure. So it has infinite technically term. So we can support companies for longer. And I think Sequoia's memo was a fantastic validation of what we were doing. And I think many VCs might take that model. Tiger has been doing it in some ways. They have separate funds, but they have been doing it for some time as well. So I'm all on board with that model we are doing.
Rupam, we have a fund formation practice here. And what I've been seeing more of lately is traditional venture funds just expanding and doing crypto assets in particular, or tokens, or things where they're not a traditional venture capital strategy. But it sounds like you've been doing that for a while.
Yes. And it's the whole point was,
right? You have to change your structure because otherwise it's all bad bucket.
Yes, we do. We spend most of 2020 sort of working with lawyers to figure out the right structure, so that we are fair to our investors. We can continue the public fund. We have to worry about.
Oh, right, because you said you're a hedge fund and you have to do your disclosure at the beginning.
Yes.
Yeah, I mean, there's another question in this which I'm not going to address public because I'm not a public market investor. I don't enjoy it, and I think my job is to get companies at the beginning of their life that could end up being public, and then the upside from there is really my LP's business. They didn't hire me to be a manager of their public stocks, and so I'm not intending. I'm going to try to be pretty formal about my distribution of public stocks to my LPs. I just, I know they can go up higher. I get it. I read Sequoia's thing. Look at Square, but they pay people to manage that. And they pay me to find seed companies that can get to liquidity, and public is a form of liquidity. But there's another piece in there, which is, are they going to dominate seed? Absolutely not. I'm told, and I have no reason to doubt the co-founder, that we won a deal away from Sequoia, Benchmark, and Excel. And it was even my partner that did it. I didn't even get to negotiate it. I'm so proud of him. He did a great job. Taylor's phenomenal. But why would they do that? Why would they take my money, our money, over Sequoia's or Benchmark? Well, because if a tier one venture firm comes in and takes your whole seed round and buys 20% of your company, two things happen. One, 20% is typically what they're looking for. They might ask for 20 to 30 and they're good to go. And two, if you go out to raise and they're not bidding, that's a challenge. Back in the day, Sequoia was the first company ever to give YC money. In exchange for that money, they got a first look at every company before demo day. They don't get that anymore. But you know what every VC said to any YC company the day after demo day when they came to pitch them? So why did Sequoia pass? Right? Sequoia is the best in the business. Sequoia and Benchmark are probably tied. Okay. So if Sequoia is passing, then everybody sits down and says, well, why am I so smart? Now, the flip side is when Sequoia sends you a deal, it's like, oh, why am I so lucky? Oh, are you thinking of me because you don't want to put your own money in anymore? Because wait, and all the successes you had, you piled in every penny you could, and you have a growth group and a public group, but thank you so much for the gift. That's the problem. You get backed by Sequoia. I'm very pro Sequoia. They're phenomenal. I love to partner with them on deals. I love for them to fund my deals. But net, if Sequoia seeded you and I'm getting a shot at the next round, you think I look at that as a positive? So the nice thing about having neutral Switzerland-like players like Ben and Tenacity Capital is I'm no signal. I don't do Series A's. I don't bid on Series A's. I will help you if I think you're ready, not if I don't think you are, because I'm not going to take you out if you're not ready to raise. But I'm at best, I'm positive signal, because since I'm only going to help you fundraise for your Series A if I think you are legitimately ready to do so. It took me 8 years to build those 300 relationships. I'm not jeopardizing those. I have way too many entrepreneurs to help. I can't help the laggard when I've got rock stars that will need the attention. I've had to get same day meetings before, and it's happened, and they've gotten funded that way, right? So I think the big folks are rolling out big funds. I will partner with them when it makes sense to do so. But net, I also assume I'll win, because selfishly, you as an entrepreneur would rather have the neutral capital. I've got 36 venture capitalists as my LPs. You think they're in it only for return? They want deal flow, right? I mean, that's what I do.
Let's keep moving here. I want to get through these questions. I appreciate that. So Jim, I want to direct this next one at you. There's a couple questions around valuation and how do you value a startup company? You know, it's interesting, the SVB, Silicon Valley Bank newsletter just this morning had an entire article on valuing startups. It was interesting what they came up with, how VC should value startups. Well, let me ask you, how do you value a company when you go to approach it?
Well, we like to look at our criteria, which is on my, it's the standard criteria, except, enterprise deep tech hardware, we look at the technology and the moat. That's pretty important. And, then we'll look at if the few deals that we do want to fund, we'll look at the market and try to come up with a fair valuation to make sure that the entrepreneur has enough. And like everybody else, that's how we do it. And it's an art, it's an art. It's not an exact science. So yeah, I would stay with that. I would, on the previous question, I would also comment that in our space, we're not seeing as much of that froth. It's not, we're not seeing the tigers coming in and so forth. A lot of that is more on the software side, but we're not seeing that on the deep tech hardware side. And so it's a more reasonable market, and I think they would have trouble in our spaces.
Mm-hmm.
Jennifer, you're going to say something?
Yeah, on the valuation side, I think we've seen three things, three buckets. It's reasonable, it's a bit aggressive, and they must be crazy, right? To be honest, and we look at it relative to other things in the portfolio. We look at it as this deal price for perfection or for growth. Are these fair and reasonable terms? And we would look at, the revenue, what's the multiple on the revenue. When I say revenue, I mean GAAP revenue. ARR is important to show growth, but people measure that differently. And I've seen some financials get reworked when people have had a wonky definition of what constitutes ARR. So a bit more focus on GAAP. And then, an interesting trend we've seen, it goes back a little bit to the last question, but the last 12 to 18 months, about 80% of the deals we've done have been extensions. The entrepreneur has extended their round, reopened the terms to let us in for the value add that we're bringing. So we'll look at the valuation, also relative to how can Mighty Capital help this company. Our unique value add is we're giving access to a product management network of some 300,000 people. So if there's alignment there in terms of helping them drive sales, hire people, meet partnerships, that sort of thing. Then we take that into account in how we look at the valuation as well. How much more valuation can we drive? But if something's in the reasonable bucket and slight aggressive, that's good. If it is in the crazy bucket, that's not where we play, because I don't want to deal price to perfection. A bit of art, a bit of pattern matching, a lot of experience is what goes into pricing these companies.
Yeah. Rupam, do you want to weigh in on this? We'll make this the last question since we're at 1:30 almost. You're on mute. Now you're good.
Hello.
Yep, now we hear you.
So sorry, I just missed that part. What question?
Well, the question is really how do you value an early stage company?
Oh, yes. For us, it's almost all an art because it's the technology that we are backing. We are backing the founder of that technology. It could be almost be a research project. So it's almost always an art. And we do have certain benchmarks, where pre-seed companies should lie, where seed companies should lie, how much are they raising. Typically, what we do is, if they're raising 5 million we first ask them, what will you do with this 5 million? And that is the first reasonability check we do. Do they even need 5 million? And if they are raising 5 million in a pre-seed round, what kind of valuation should that justify? It cannot be 100 million valuation for a company which only needs 5 million to do its work. So that somehow gives us a range. Perhaps 5 million, the valuation should be 15 to 25, looking at reasonable levels of dilution. So those are some of the markers we use. We have comparable analysis. Where do AI companies raise in their pre-seed rounds? But it's very much on the art side for us. No revenue multiples, nothing that we can look at.
Okay, got it. Thank you very much. Well, we are at 1:30 Pacific. I want to thank our panel for being here. That was really interesting. Learned a lot. Thank you, attendees, and thank you to Idea to IPO. We hope that we see you again. I posted, I'm going to send a link with a recording if you want to watch us again. We talk pretty fast. I know that. And you can also go to the YouTube channel. Make sure you join our Startup Solutions LinkedIn page so you can find out about more of these events as they come up. And with that, I'm going to conclude the webinar. Thank you very much, and we will see you next time.